In this market update, I'm going to be talking about inflation expectations and liquidity in the market. Hi, Jim Gore from THOR Wealth Management. Well, we're seeing yo-yo numbers in the CPI, where the first 3 months CPI was higher than expected, and then the last reading was very good. So the question is, what is the Federal Reserve thinking? Well, if you look at what the Federal Reserve is doing, one of the things that they look at very closely is inflation expectations. And now this is a longer term chart going back to the mid-70s. If you look at this, the inflation expectations went up in the last year or two, but then it's come down. We're nowhere where we were back in 1979 and 1980. And a lot of people are saying, well, that's good. We're not going to have inflation like that time period. However, keep in mind, and you can go to shadowstatistics.com and look at this. If you look at how inflation was calculated back in 1980, if it was calculated the same way today, inflation would be running about 6 to 7%, not the quoted 3% number. Keep in mind, the federal government has a good reason to keep inflation low through their numbers because Social Security is tied to that, and that's a big payment that they have to come out. But so let's look at this chart on a shorter term basis over the last 10 years. And this is looking at the inflation expectations. And you can see here the inflation expectations from where we were 2 years ago come down from a little bit about 5.5%. We're now at 3.2%. It has come down. That's good. However, it is still higher than the 2% rate that they want. And it's much higher than what we were pre-COVID from 2015 to 2020. So we're about 1% higher interest rates. So the Federal Reserve should be a little bit tighter. The question is, are they being tighter? Well, we would argue that actually they become a little bit more lenient. And you can, not in interest rates, but in selling off their securities. They've reduced that. And so when they're reducing the selling off the securities, they're freeing up more cash in the economy. And that's being shown up here in M2. This is the money supply. And this is year-over-year growth. And you can see that the money supply actually grew by over 25% during COVID in 1 year. It should grow at 4 to 6% per year in order to keep pace with a 2% inflation rate and population and economic growth. So what the Federal Reserve is, they tighten with higher interest rates and selling off securities. However, it was down to negative. Look at what's happened in the last year. Money supply growth has actually grown over the last year. A little bit, but it's grown. That means the Federal Reserve is not as tight as what they were. So the federal government is actually, and the Federal Reserve is being a lot looser with their policies than they were just a year ago. And that's reflected in the stock market going up as more cash maybe has gone into the markets. But the question is, has more cash gone into the markets, and do people have enough cash to keep the market flowing? Well, the Federal Reserve is going to do their part by trying to get more cash out there. But if you look at this chart here, this is how much cash is available in brokerage accounts. And you can see here that the cash has come down quite dramatically. People have been taking that money, putting it into the market. Well, the market has gone up. But now cash is below where we were back in 2017 and 2018. So the question is, will people have cash to keep this market going? Well, one way to look at it, Federal Reserve is adding more money to it. Are people saving money to put into their brokerage account? Well, this is looking at the savings rate out there, and you can see the savings rate is low. It's one of the lowest areas except for 2007, 2008. And so people are not saving as much, and we hear all those stories about credit card balances are going up, mortgage rates have gone up, and people are using more of their money to buy food. Well, if they're putting more of their money towards food, gas, and other things, that has less money to go into their investments for investments to go up. So we have two counterbalancing things right now that are happening. The Federal Reserve is being a little bit more lenient with the money that's out there, but at the same time, investors don't have as much cash to go out there and put into investments. So it's going to be very interesting to see what happens going forward, but this is why you want to have things in your portfolio that are just not tied to the market. You want to have things that are uncorrelated to the market. You want to have some alternatives. You want to have some things that will do well in an inflationary environment, because I don't know if inflation is over, because we could have a spike like we did back in the late 70s, especially with the continued spending by the federal government. If you have any questions or concerns or need help with your portfolio, as always, reach out to us at thorwealthmanagement.com or give us a call. Take care, and I won't be doing a market update until 2 weeks after July 4th. I hope everyone has a fantastic July 4th. Take care and talk to you soon.